We just had the House resolution bill go through Congress last week, and they were claiming it had no tax on tips and no tax on overtime and no tax on Social Security. There are a lot of different tax ideas being thrown around, and they all sound probably pretty good. There's already been a bill filed in the U.S. House to abolish the IRS and to go to what they call a consumption tax. What that is it's a sales tax. So you would pay a tax on every single transaction that you engage in. So your rent, your house payment, your car payment, your groceries, your electric bill, your water bill, your cell phone bill, your internet bill, your streaming services, anything that you buy online, anything that you buy at a store, literally every transaction that you engage in would be taxed. And what they proposed in the bill that was filed in the U.S. House was $23 per $77 of purchases, which makes it sound like a 23% tax, but it's really like a 30 some percent tax, about 30%, because it's $23 on $77 of purchases. It's not $23 on $100 of purchases. So that is misleading. But we also pay property taxes, state income taxes, we pay local and state sales taxes, and we pay income taxes. And then there's another idea floating around, a fair tax or a flat tax. And what that is where everybody just pays the same percent of their income in taxes. And so I'd like to take a little bit of time to explain each one of these and how they impact people at different levels of the economic or income scale, so that people can make an informed decision on what tax system is best for them. The current tax system is called a graduated income tax system. And what that means is the percentage of tax that you pay on your income increases as your income increases. Now, that doesn't mean that somebody that makes $100,000 a year, they would be in the 22% tax bracket. They don't pay 22% on all of their income. They only pay 22% tax on the income that falls into that income tax bracket. So everybody in the United States, if they make $11,600, they're going to pay 10% of taxes on that amount. If you make more than $11,600, then you're going to pay 12% on the income from $11,601 up to your income $47,150. And then if you make more than $47,150, you pay 22% income tax on the dollars that you make above that up to $100,525, and so on and so forth. And so right now, the top income tax bracket in the United States is 37%. And individuals who make $609,351, they pay 37% on every dollar they make over that amount. So from $6,90351 and up, they pay 37% on just that part of their income. What that gives you is you'll end up with a blended tax rate or an effective tax rate. Your effective tax rate is always going to be less than your tax bracket tax rate, because it's going to average the taxes that you pay in those lower income brackets altogether. Then the other components of our tax system is we have a deduction system. And so first, what you do is you figure out what was your total income for the year. And then you figure out, okay, what deductions can I take? So in the US, we have a standard deduction, which is $14,600 for a single person. And then it's double that for a married couple. And then there's a head of household, which is a single person that has children or dependents in their house. And they get a standard deduction, which is like somewhere in the middle of the $14,600 and the $28,000-ish for a married couple. The head of household is somewhere in the middle. And so what you do is you take the amount of money you made in the year and you subtract that deduction amount, and that is your taxable income. Now, if you have a business, or there are other things that can be itemized and deducted. And so if your itemized deductions, so that be like house mortgage. You'd have to read the whole tax code, which I will show you. This right here, this is my copy of the tax code from when I took federal tax in law school, about last year, maybe, I think a year ago. The tax code is almost 2,000 pages in this tax code. And so there's a lot of stuff in there that doesn't apply, to everybody. But if your itemized deductions are more than your standard deduction, then you can take the itemized deduction and you can actually reduce your taxable income even further. You also have tax credits that after you figure out your amount of taxable income and then you apply your tax bracket or your percentage of income tax that you're going to owe to your taxable income that you just figured out. So then you can apply tax credits. And tax credits are things that the federal government has decided they want to encourage. And so they allow a dollar for dollar recognition, like you paid that amount in taxes. And so there's a child tax credit that's a couple $1,000s. There's a child care tax credit that you can get up to $6,000 credited towards your taxes. There's a homestead tax credit to encourage people to buy houses. There's tons of tax credits. There's renewable energy tax credits, which those might be going away, but they were in place for a very long time. If you bought an electric vehicle, if you put energy efficient windows in your house, if you put energy efficient heating and air conditioning in your house. So there's tons of different tax credits available within the tax code. And what those do is they then, once you find out how much tax you owe, then you apply your credits, and that reduces dollar for dollar the amount of tax that you are required to pay. And some tax credits are refundable and some are non-refundable. And so a refundable tax credit, like the child tax credit, is a refundable tax credit. And so if you actually paid more money in taxes during the year than you owed, and then you had this child tax credit that took you to saying that you actually didn't owe any taxes and you actually had a surplus that you paid in, then a refundable tax credit, you are able to get that back from the government. And then non-refundable tax credits, if you have non-refundable tax credits and it reduces your tax owed down to zero, and then it even goes further, you don't get that in a refund because it's a non-refundable tax credit.
Here's an example of how the current graduated income tax system currently works. So if you have a single person making $90,000 a year, they're going to be able to take the standard deduction, $14,600. That's going to reduce their taxable income to $75,400 per year. Now, if you apply the current tax code, I think this is the 2024 rates and breakdown. So they're going to pay $1,160 on their first $11,600, $4,266 on their income from $11,601 to $47,150, and then they're going to pay 22% on their amount over that, up to their taxable income of $75,400 for a total of $6,215 in that tax bracket. So their total tax owed is going to be $11,641. And so as you can see, they're in the 22% tax bracket, but their effective tax rate, which is the amount of taxes owed over the taxable income, is 15.4%. So it's not 22%. Now, if this person was pursuing some kind of education, they would be potentially eligible for one of the education tax credits, which has maximum of $2,500 per year. So then they could take that $2,500 per year off of their taxes owed, and that would leave them with a total taxes paid of $9,141 for that year. And then if you compare that with a married couple with one child who is making the same $90,000, the married couple is going to get a standard deduction of $29,200 because that's double the deduction for a single person. So their taxable income is actually only going to be $60,800. So they're going to pay the same 10% on their first $11,600, so $1,160. and they're going to pay the same 12% from $11,601 of income up to $47,150 of income, so the same $4,266. And then they're going to pay the same 22% on their income between $47,151 up to $60,800, and so that is going to be $3,003 of taxes in that tax bracket range. And you see that's different, and it's because their taxable income is actually lower because they get more of a deduction. So their taxes owed for the year is going to be $8,429, and that's going to be 13.9% effective tax rate. So you can see, once again, they are in the 22% tax bracket, but their effective rate is much less than that. So now let's say that one of them also is pursuing some kind of education, and so they're going to get the $2,500 education credit. They have one child, we said when we started, so they're going to get $2,000 for a child tax credit for one child. And then if that child is in daycare, childcare, some kind of care program, they will be eligible to get up to $3,000 in a tax credit for dependent care tax credit. And so by taking advantage of all of those, their total taxes owed for the year is actually only going to be $929.
One of the alternate income tax models is called a flat tax. And under a flat tax, every person would pay the same percent of their income in income taxes as everybody else. It wouldn't matter how much money you made, and it wouldn't matter whether it was income or capital gains. Just everybody would pay the same percent.
If you then compare the current graduated tax system to a flat tax system, even if we said 10%, both of these families, single person or a married couple, making $90,000 a year, they're both going to pay $9,000 in taxes. Now, if, let's say, the flat tax gets set at 15%, well, that's going to go up to $13,500 per year that they would each be paying in taxes. And I haven't seen any kind of proposals on what a flat tax percentage would be. But as you can see, this family is going to pay a lot more. This family might save $141, but that's only if tax is capped at 10%. If it's 11%, this person is going to be paying more in taxes as well under a flat tax system.
If you made $15,000 a year, you would pay $1,500 in federal income taxes. And if you made $100,000 a year, you would pay $10,000 in federal income taxes. And if you made $1 million a year, you would pay $100,000 in federal income taxes. Now, people say that, this is not good for working and middle-class families because households with lower incomes, and if you think about households that are living, paycheck to paycheck, they would be spending a higher percentage of their earnings on the necessities to live. And a flat tax makes it harder for them to save or invest because you don't have the incentives embedded in the tax program, like the child tax credit, the child care tax credit, education credits, things like that, encourage people to have kids or help them out with being able to afford children, or the education tax credit, which there's several of them, but it encourages people to seek higher education, which then means that they can, apply for promotions or better paying jobs. And so it encourages upward mobility in the working and middle class. And so they say with a flat tax, you wouldn't have those incentives, and so it really would make it harder for those families that are living paycheck to paycheck to basically improve their situation in the economy. And under this type of system, the wealthy would pay extremely lower amounts of taxes than what they pay right now. So the wealthy would get significant tax cuts under a flat tax plan. Now, they do say, a flat tax plan would make filing your taxes easier. But the other thing is, a lot of people in the working and middle class, they get a tax refund check every April. And when you think about, rent and utilities and that kinds of things, where in cold weather states you have restrictions on evictions and cutting off utilities during the colder months, those families, a lot of them get behind, and then in April when they get their tax refund, they're able to get caught up with their landlord and their utility provider. And so without having kind of that built-in savings program for working and middle-class Americans, you could have a ripple effect into your utilities services and your landlords and property management, where these families are used to getting that refund check in the spring where they can get caught up and basically have like a reset for their financial coming 12 months. So you could see a significant ripple impact with decreases in revenue for your utility and your property management / landlords. Another model that has been floated as a replacement for the income tax system is a fair tax or a national sales tax or a consumption tax. And basically the bill that was filed in the U.S. House of Representatives basically says to abolish the IRS and establish a national sales tax. And it says that it would be $23 on $77 worth of purchases. And so it makes you think it's like a 23% tax, but when you do the math, that really comes out to about a 30% sales tax. And if you read through the whole bill, which I did, it taxes everything at 30%. Your rent payment, your car payment, your house payment, your utility bills, so your electric, water, internet, phone, clothes, anything you do at a store, brick and mortar, anything that you buy online. It literally would tax everything that you spend money on. So if you look at your monthly budget and you look and see how much money you spend every month. So for me, I did that, and my monthly expenses are, I don't know, like $5,000 for a 4-bedroom house with people living in it. My taxes under this plan would be about $23,000 per year, which is like, I don't know, almost 3 times what I pay in income taxes under the graduated income tax system that we have right now. So, people say, oh yeah, a national sales tax would be fair because everybody would have to pay the same percent on everything that they purchase. But it overly burdens middle, working class, and those living in poverty because, they have to buy food, water, clothing, rent, and it's taxing people on what you spend on your basic needs. It's not taxing you on buying luxury items, right? People that are in the middle and working class are not buying luxury items. So it basically shifts a larger portion of the funding of the government onto people in your lower income ranges. Another thing I read through the bill, and it basically, if you buy things out of the country, you are left up to your own basically conscience if you report what you bought and pay the taxes. So wealthy people could literally hop on a jet and fly to Paris and go shopping and come back and not pay this tax on any of their purchases because it's left up to them to self-report and self-pay the taxes. Where the rest of us who don't have the means to jump on a private jet and go shopping in another country, we have to do all of our shopping here. All of those taxes would be collected at the point of sale. And so we would be directly taxed here on everything that we buy, when the wealthy would still have an easy out on how to avoid paying these taxes.
Now, this is an estimate of a family's expenses: gas, groceries, utilities, phone, internet, car payment, car insurance, life insurance, medical insurance, house payment or rent, all this stuff. I just estimated like what it would be. And so those expenses come out to be about $76,000 per year. And so if we abolished the income tax that we have now and went to a 30% national sales tax, or a consumption tax is what they call it, this family would actually end up paying $22,818 a year in taxes.
So the bottom line when it comes to how do you fund your government via a tax system, a flat tax where everybody pays the same percent. This is going to benefit the wealthy because it's going to reduce the amount that they're paying, and it's going to overburden the individuals and families in the working and middle class. If you go for the fair tax or the consumption tax or the national sales tax, whatever you want to call it, that is going to shift your tax burden on, how do we fund and support the government and all the services that we get from it, from your wealth to your spending habits. And this, once again, disproportionately hurts working and middle class families and the poor because your bare necessities, things that you absolutely need to live and have to spend money on, are going to be taxed at exactly the same percentage as luxury items and purchases. And also, the bill that is currently in the U.S. House of Representatives does tax every transaction that a middle and working class family would make. So historically, in looking at income taxes or taxes that fund a government, a graduated income tax system has been found to be the most fair across all income ranges. And so we've had the income tax in the United States since something like 1916, I think. And so it's been around a long time, and yeah, maybe it does need to be fixed and changed. But I would argue that what needs to be fixed and changed about it would be all the exemptions and all the ways that wealthy people can get reductions in their taxes and avoid paying taxes. One of the things that is not taxable, loans are not taxable. So if you take out a loan, it's not taxable on the money that you get. So you take out a loan to go buy a car, you don't get taxed on that loan in your annual income taxes. Well, people like Elon Musk, who own all these companies and they have all of this wealth tied up in these companies, what they can do to avoid having income is they can take out a loan, for millions of dollars against the value that they have in the stock market or against the value of ownership that they have in a company. And then they can use that money to live off of, and they can then pay the loan off with, whatever income they are taking out of their business. And they literally can claim deductions for the interest that they're paying on the loan. And they get the benefits of having all of this wealth, and they never pay taxes on any of it. And it's fairly common that they do this. And so what's crazy about this to me is you can tell how the government kind of singles out like celebrities. And, this latest tax plan they wanted to cut the tax loophole for sports franchise owners, which is a very small percentage of people in the United States. I mean, how many sports franchises are there? There's like 100, right? If you look at NHL, NBA, WNBA, NFL, MLB, I'm probably missing somebody, Major League Soccer, but there aren't that many sports franchises in the United States to where these sports franchise owners are a large amount of tax revenue for the government. And then also they implemented a rule several years ago that like a celebrity, if they, let's say a famous designer loans a celebrity an outfit to wear on the red carpet at an awards show, the IRS tax rules were actually changed to require that celebrity to pay taxes on the value of the use that they got out of borrowing the outfit, or purse or jewelry or whatever it might be. And so they're writing these rules to make very small groups of people pay taxes on things, but we're not looking at implementing similar rules to make multi-billionaires pay taxes on basically doing the same thing to take value out of their company in the form of a loan and live off of it, instead of taking an income that they would have to pay taxes on. I have HR 25. This is the draft of the same bill from the last Congress, but this was enrolled in the 2025 Congress. And this is a bill to eliminate the IRS, eliminate income tax, and replace it with a national sales tax or national consumption tax that would put $23 of taxes on a purchase of $77. So I have my little calculator right here. So $23 of tax on a $77 purchase is 29.87% tax. So 30% sales tax. So think of everything that you spend to keep your house running, to clothe your children, feed your children, put gas in your car to go to work. You think of all of that, and you're going to add 30% to the cost of everything that you have to buy. That's what this bill does. And so in the beginning of it, they make it sound pretty good because they say to promote freedom, fairness, and economic opportunity by repealing the income tax and other taxes, abolishing the Internal Revenue Service, and enacting a national sales tax to be administered primarily by the states. Now, we can get into the constitutionality of that. I mean, there's court cases that say that the federal government cannot force the state government or the state government entities like your local police, your, state tax board, whatever. The federal government cannot force or ask the states to do federal government tasks. And there's Supreme Court cases that say this. So number one, probably unconstitutional to begin with, to make the states carry out all of this tax plan for the benefit of the federal government. So, but I'm going to leave that one alone. So they call it the Fair Tax Act, which we know it's not fair, but we'll leave that. And it says, the Congress finds that the federal income tax retards economic growth and has reduced the standard of living of the American people. It impedes international competitiveness of United States industry. It reduces savings and investment. It slows capital formation necessary for real wages to steadily increase. It lowers productivity. It imposes unacceptable and unnecessary administrative and compliance costs on individual and business taxpayers. It's unfair and inequitable. Unnecessarily intrudes upon the privacy and civil rights of the United States citizens. Hides the true cost of government by embedding taxes in the cost of everything Americans buy. And it's not being complied with at satisfactory levels. So basically they're admitting that they know people cheat on their taxes. And it's not the middle and working class that's cheating on their taxes. Okay. And that it impedes upward social mobility. So, number one, I'm just going to run through these and I'll tell you, these are my challenges, right? I will start with, it imposes unacceptable, unnecessary administrative and compliance costs on individual and business taxpayers. So what they are claiming here is because your employer every 2 weeks, if you get paid every 2 weeks, every month, whatever, but every time your employer runs payroll, they have to run payroll, they have a software program that does this, and then they have to remit to the federal government all of the taxes that are withheld from all of the employees' checks. So they have to do this every 2 weeks or every month or twice a month, whatever you get paid at your company. Okay? And then they're saying that it's a burden on business owners to do this. Now, what they don't tell you is if you actually go and read through this bill, the way that they want to administer this national sales tax, first of all, they want point of sale vendors to charge it and collect it. And then they want it to go to a group in your state government, whatever your group is that collects taxes right now. And then they want your state government board to separate what belongs to the federal government and then to send it back to the federal government. Now, that sounds all well and good, except there's also a portion in here where it says that if taxes aren't remitted to the federal government within 5 days of being collected, that there's going to be penalties. Now, whether the penalty is going to be on the state government body that was supposed to send it in, or if it's going to be on the shop owner who sold you the stuff and collected your tax, if he didn't send it to the state board within 5 days, it doesn't really specify that. But how is it less burdensome to make businesses send taxes somewhere every single day at the end of their business day, as opposed to them just having a computer program run payroll and send it to the federal government every other week when you get paid? Like, this completely doesn't make sense. This would be much more burdensome on your businesses who are selling things and, collecting money for sales. absolutely insane that they would say that this is going to reduce the administrative burden on people. It's not. And then it says that it's to reduce the administrative burden on individual taxpayers. So that's like us, right? So we file our taxes every year in April, right? By April 15th. So we have to file one time. We get all of our stuff together. We send it to the federal government. Either we pay or they send us a check, whatever, one time. Now, that's all well and good. If this meant I didn't have to do that ever, that would be great, because they're going to abolish the IRS, no income tax. I'm not going to have to do that. However, if you read through this bill, you will find out that in October of every year, you have to register your family unit with a new government agency that they're going to create. And you have to record everybody who's living in your house at that time. And there's no age limit on who can live in your house. So, I mean, grandma, your brother that just got divorced, like they can all come, and you register them. And then you then have to register them based on the number of people in your house, if you register, they're going to send you a check every month for like your portion of refund of this tax money. And so I looked at it, and it's like for a family of 4, they base it on the poverty level. So like a family of 4 is going to get like $650 a month back from the federal government. If you have a college age kid and they go away to college, they don't get to claim it themselves. They have to stay on yours. So they're going to be off at college, like spending money on, books, school supplies, food, whatever they might need. And they're not going to get any of the monthly refund. It's all going to come back to the household. And you have to register. When you register, you have to identify who is the head of the household, and they literally specify that it should be the man. They also talk about if you are divorced, only one person can get it. It can't be split, and it's the person who is the custodial parent. But it makes no allowance or guidance for if you have 50-50 custody to decide who should get it. So basically, you lose, one parent's going to lose the benefit of getting to claim a kid on taxes. So that's crazy. And then the other thing is, they say we're reducing the burden on the individual taxpayer. Well, it also goes through, if you have changes in your family through the year. So let's say, you have a kid, they get married and they move out. You have to re-register. Every time you have a change in the head count in your household, you have to re-register. And if you have a person over the age of 21 who you're claiming, they have to sign it. And I think it has to be like notarized, or they have to sign an affidavit. So they're not reducing the administrative burden on the individual taxpayer at all. But they are stealing money from other people in the family and giving it to one person in the family. Now, the other thing that I calculated is, like a family of 4 would get like $650 a month back from the government out of this tax fund. But a family of 4 who lives in a house where you have like a $2,000 house payment, maybe you have a $600 car payment, and then you have like standard utilities, and you're buying groceries for 4 people, blah, blah, blah. Your actual tax bill is going to be about $24,000 a year. You're going to get $650 a month back from the federal government, but $650 a month is only about like $8,000 a year. So you're still going to be paying $16,000 a year in taxes. And that's before like your car breaks down and you have to buy a new car, because you're going to pay 30% sales tax on your new car. So if you think a car is expensive right now, just wait for this. So that's one of my points of contention. It says that the current tax system is fair and inequitable, which if you go and you can even use like ChatGPT to do this. Even ChatGPT will tell you that a graduated tax system is the most fair and equitable tax system in existence, because it takes into account the fact that everybody has to buy food, everybody has to have shelter, everybody has to have water, everybody has to have clothing. And so you pay a very low percentage of tax on your base income, and then only those people who make much greater incomes pay much greater taxes. And basically it's acknowledging that, no matter what your income is, everybody has these base expenses, that you need to live. And so we should be fair in assuring that people aren't being taxed to a point where they can't afford their basic necessities, which is exactly what a national sales tax or a national consumption tax would do, because you would be paying the 30% taxes on everything you buy, including your bare necessities, because it doesn't identify anything as a luxury item. And then it says the graduated tax system we have right now impedes upward social mobility. It does not. If you actually run a comparison through an AI tool of the tax systems that they propose, you'll find that a graduated income tax is actually the best for promoting upward social mobility, which means basically, people striving to, improve or get an education in order to get promotions and move up in their income status. That's upward social mobility. This also says it hides the cost of true government and hides it in like everything that you're buying. The income tax system does not do that, but a national sales tax would absolutely do that. It would 100% apply the cost of government to every single thing that you purchase. The other thing is, a wealthy person could go out of country to buy what they want and avoid the tax altogether, and there's no requirement or no enforcement for them to actually report what they bought and pay the tax when they come back. So as far as them saying that the current tax code isn't being complied with, that is also going to be true in this new tax system that they are proposing. It also says that the current graduated income tax system says slows the capital formation necessary for real wages to steadily increase. Real wages are not steadily increasing because trickle-down economics doesn't work. We've been sold a pile of horse shit since 1980 that if we give all of the money to the wealthy, to the capitalists, to the companies, that they will create these jobs and then everybody will have enough and, we'll be sufficient to support our families. That hasn't happened. Now, one of the reasons that hasn't happened is because regulations have kind of slowly been whittled away over the years. So it used to be that companies could not participate in stock buybacks. Now, when companies get large windfalls of tax cuts or stimulus, instead of creating jobs, they can use it to buy back their stocks. It happened during after the Great Recession of 2008-2009, and it happened again after the COVID pandemic. Those two events led to significant concentration of wealth in the upper 1%. Another thing that this bill proposes to do is to eliminate gift and estate taxes for the wealthy. So, right now, if a wealthy family, couple gives one of their houses to their children, the child would have to pay taxes on the value of that gift over a certain amount. So this bill seeks to eliminate taxes on gifts. And so, if a working or middle class person is like, yeah, we don't want to be taxed on our gifts, trust me, honey, you are never getting a gift large enough that it would be taxed under the current tax system. It's not going to happen. You're not getting a gift that big. Then this bill goes into how 45 out of the 50 states already have sales tax systems and they're already collecting sales tax for their own funding. So it wouldn't be that hard for them to just collect all of this sales tax for the national sales tax, and then they can just submit it back to the federal government in order to fund the federal government. Well, once again, having the states perform federal duties for the benefit of the federal government or to carry out federal law is not constitutional. It's called commandeering, and they can't do it. They would need to establish their own tax agency to collect these taxes and send it back to Washington, D.C. And then the absolute funniest thing that I found in this bill was switching to this national sales tax system or national consumption tax system will respect the privacy interests and civil rights of taxpayers. Explain to me how having to register my family unit with the federal government once a year and more if I have changes, like if I have a baby, if somebody dies, if somebody gets married and moves out, some extended family gets divorced and somebody moves in. Like, explain to me how registering my family at least once per year, and then additionally every time I have a change in my family unit who's living in my house, explain to me how that is more privacy than just filing my federal income taxes once a year like I do right now. Please explain that to me. Another thing I find interesting in this bill is, they talk about it's going to abolish the IRS, which at the very end of the bill, it has a whole section that says, if the 16th Amendment to the Constitution of the United States is not repealed before the end of the 7-year period beginning on the date of enactment of this act, all provisions of and amendments made by this act shall not apply to any use or consumption in any year beginning after December 31 of the calendar year in which such period ends. So they know that this entire bill is completely unconstitutional because of the 16th Amendment of the Constitution. So the fact that they're trying to pass a bill that's completely unconstitutional, well, I mean, honestly, in this day and age, with this Republican party, not surprised at all. I mean, they're doing unconstitutional stuff every day. But they know that it's not even constitutional what they're trying to do. So, yay. But they want to abolish the IRS, right? So they want to get rid of the IRS, fire everybody that works for the IRS. But then later in this bill, it says, oh my goodness, we're going to have to establish a federal agency to carry out all of this work. And so what that leads to is, number one, they can basically possibly just establish a federal agency and then staff it with contracted employees. And so you would not have the privacy protections that you have with federal civil service employees who have to, basically take an oath that they are not going to use your data and they're going to uphold the Constitution. Private contracted employees who work for contractors to the federal government do not have to make those promises to you. And so this bill opens up the door for them to outsource the processing of all of our taxes, and all those family registrations about who's living in your house opens up the door for private companies to have their hands on every single one of those that you file. So the last thing that I will say about this bill is all transactions of tangible property, so that's like things that you can touch, things that you can move around, and then transactions of real property, so that's like real estate, buying a house, leasing a property, renting a place to live. All of those are covered under this national sales or national consumption tax. So you're going to pay 30% on all of those transactions. However, there are certain intangible properties that are excluded, and intangible properties are things that you can't touch and you can't physically move around. So those are things like investments or banknotes. So if you can think about who's benefiting from investments and banknotes, not me. I work in a factory, so it's for sure not me. But your big investment bank firms and your BlackRocks and your Zuckerbergs and your Elon Musks, they deal and hold almost all of their wealth in intangible property. So this national consumption tax is definitely not a fair tax. It will significantly transfer the burden of funding all of the government onto poor, working, and middle-class Americans. And as a side note, because of the family registration system, it also will reduce the kind of economic freedom of women unless they can convince their husband to let them be the head of household and get the check from the government every month. But that's not what they want. They want it to be the man of the house getting that check. So, yeah. Once again, a tax plan for the wealthy by the wealthy.